Hey, what's up? I'll tell you what's up. New listings of houses for sale are now up 11% compared to last year. And what's more is we now have 90% more active houses for sale total in February, just last month, compared to 2 years ago. So we have active listings up and we have new listings up. Both things are good if you're out there looking to buy a property or maybe even invest in real estate. And that's what we're looking at today. We're looking at an article from Resiclub Analytics and Realtor.com to understand how much inventory has actually increased and are we headed for some type of catastrophic crash? Let's find out. Here we go. Hey, but real quick, I want to give a plug out to a Mr. Jason Walter. Jason helps me with my YouTube editing. He also is a real estate agent in Sacramento, California, and he's a YouTuber who covers real estate. His link to his YouTube page is in my description below. I encourage you to check him out. And if you need some video editing, he can do that too. All right, here we go. Let's look at some of the data. So to understand the inventory in the United States and really what's going on, we're going to look at an article from ResiclubAnalytics.com. Resiclub, the links in my description below, is a fantastic data analytics company that you can access really anytime. They have a lot of free data. They have a paid subscription too, but this article is free and the link's in my description below. Check it out. So we're going to look at inventory and new listings in the United States for existing houses. So the name of the article from Resiclub is "The Housing Market's Lock-in Effect Continues to Ease." So the lock-in effect, real quick, just to explain that, that's the effect that basically the market has been experiencing over the past couple years because interest rates have been super high compared to where they were a couple years ago. And now people don't want to sell their houses. They're staying put. They don't want to give up their 2 and 3% interest rates. And so they're staying put and inventory is not hitting the market. That's really the lock-in effect. All right, so let's go to the article. On Tuesday, we received data from Realtor.com for February 2024, indicating a measurement of 339,000 new homes for sale last month. This represents an 11% increase compared to February of 2023, when there were 304,000 new listings. However, it's important to note that this figure is still 17% below the level seen in February of 2019, when there were 409,000 listings. In simple terms, while the lock-in effect is easing, it hasn't completely dissipated. So Lance takes the Realtor.com data and he creates different charts for it to demonstrate what's happening with the market. And so this chart, I guess you could call it, it's a custom chart from Lance, which is pretty cool. So you could see in February of 2024 where we are, and we're certainly higher than 2023. That's great, right? But we're way under 2022 in terms of new listings and even 2019, 18, and 17. So you go all the way back into 2017 and new listings are far under where they were before. And so now he goes into each year and highlights February just from a text standpoint, so you can look and see, hey, where were we exactly? Well, back in 2017, we had 437,000 new listings hit the market in February of 2017, then 433,000, then 409,000, 413,000 and so forth. But do you see a pattern? There was a year in 2020 where the new listings actually increased. But for several years from 2017 through 2019, they actually dropped, which is surprising because, interest rates hadn't increased yet and there was really no lock-in effect necessarily. But then look at 2021, 22, and 23, it continued to drop down to 304,000 listings for the month total. Now, February 2024, we're at 339,000 listings. So while we have made improvements, it's not by any means robust with new listings. So the article goes on. The reason that new listings still remain suppressed boils down to switching costs. Spiked mortgage rates have made the prospect of trading in a lower monthly payment for a substantially higher one a daunting financial challenge. This financial burden, coupled with the psychological aspects of the change, has contributed to a reluctance among homeowners to list their properties for sale. Yeah, so I can tell you, as a real estate agent in Ohio here and as an investor, there's no doubt the lock-in effect is real. I have client after client that has told me, and just people that I've networked with that say, hey, I'm not going to sell my house, Jason, because I have a 3% interest rate. Why would I? However, I do have some clients now over the past couple months that are starting to think, well, I don't see interest rates dropping back down to 4% anytime soon. So I've got a nice 3% rate now, and I do have to move for whatever reason. So I'm going to give up the rate and go ahead, cash in my equity, and buy something else. Now, some of these folks are actually buying less expensive properties. They're going, all right, I have my expensive house now. I built up a bunch of equity. I have a low rate, but I want a less expensive lifestyle. I want to downsize a little bit, maybe move to a quieter spot out in the country or something. So I'm going to sell my big, nice home, pocket some money, deal with the higher rate for now, because later, hopefully, I can refinance and then downsize. So that's what people are doing somewhat. Now, there are people that are never going to sell probably because of their 3% rate. So there are some people that are deciding, you know what? I'm done waiting. It's time to actually sell. So back to the article. However, as time goes on, life events such as expanding families or other significant changes can act as catalysts in reducing so-called switching costs. Some people will simply get tired of waiting for mortgage rates to fall and will move on with their lives. And this is true. Again, I have some clients decided, done waiting, time to move on. So the big picture for new listings, the lock-in effect is easing a bit as the initial mortgage rate shock recedes in the rearview mirror, and as some homeowners come to the terms with the fact that their life circumstances have changed and that sub 4% mortgage rates aren't returning anytime soon. Okay, so we know new listings are up compared to last year, but they're still way under compared to where they were before the pandemic. No doubt they're 17% under where they were in 2019. And you can see that on the chart here. Lance has it laid out, the months, and then the color codes are the years. And you can see, new listings in 2019 were much more robust than they were just over the past couple of years. So now we know new listings are more than last year, but let's look at active listings, because this will determine really not necessarily new listings, but active listings will tell us where the market could be headed. So this data, the active inventory, is something you should definitely keep your eye on if you're trying to figure out where the market's headed locally for you, because real estate is definitely hyper local. So it says, when assessing the current home pricing trends, we believe it's more prudent to monitor active listings and months of supply. If active listings start to increase as homes remain on the market for longer periods, it may indicate potential future pricing weakness. Conversely, a rapid decline in active listings could suggest a market that is heating up. So keep an eye on your current market, because if inventory builds and days on market builds, that could be a sign that prices will go lower. So keep an eye on your current local market, because if inventory and active listings build, that could be a sign that prices are heading lower. Conversely, obviously, like the article said, if you start to see a ton of properties hit the market, but they're coming off quick too, and the inventory isn't building in your price point, remember that, in your price point, then you can probably assume prices could go up. The fact that there isn't an excessive amount of inventory on the national market is a core reason why spiked mortgage rates and strained affordability haven't translated into a more regional home price correction. In February of 2024, just last month, there were 664,000 active listings on Realtor.com. That's a 15% increase above February of 2023, when we had 579,000 active listings, and 91% above February of 2022, when many homes were selling so fast they weren't being registered as inventory. But it's still well below the pre-pandemic levels. Active listings in February of 2024 were 40% below February of 2019 levels, when there were 1,102,000 homes for sale in the US. So yeah, can you imagine that? 1.1 million homes for sale. Right now we have 600 and some thousand. So the question is, and comment below, I'd love to know from you, do you think the market and the United States could handle 1 million listings right now? What if we had 1 million active listings today? I mean, if it happened all of a sudden, it would be a catastrophe, obviously. But even if it was gradual, it's hard to imagine having that many homes for sale. I mean, you kind of get used to what you get used to, right? So right now, like as a real estate agent, I'm used to like not having a lot of inventory on the market. I mean, for my buyer clients, even the seller clients, in a way, it would be nice to have that level of inventory back, to have some flexibility in the marketplace and, some normalcy. So yeah, now you can look at this chart. that Lance outlines. And this really is, it's fantastic data. It shows you February of 2024, where we are now, and each year where inventory levels were. So what's interesting is you have 2021, 2023, 2022. We have more inventory than any of those years. We have less inventory than 2020, than 2019, 2017, and 2018. So clearly the inventory is building. There's no doubt. However, you definitely have to look in your local market and find out what's happening with inventory. And you can do that in a number of ways. I'll go over that in a second. So let's finish out the article. So in February, you can see 2017, we had 1.1 million active listings, right? And then it basically went down, 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 and it finally went up in 2023 to 579,000 and then 664,000 this year. So it was definitely headed on a downward trajectory over the last, 5, 6, 7 years. But just last year, it spiked a lot. You could see how far we are from the lows of 346,000 listings. You can also see how far we are from the highs of the 1.151 million active listings. So big picture for active listings. While active listing levels are rising year over year, national inventory levels still remain well below pre-pandemic levels. This suggests we're witnessing more of a balanced housing market than a crashing one. And I agree. If you had an explosion of active inventory because of a ton of new listings, then prices would probably soften, but we're not seeing that. And so there's a lot of folks out there right now that I watch on YouTube and, in the media and whatnot, and even people around here in Ohio that are in real estate, and they constantly say, the crash is coming. I'm waiting on the crash. The crash is coming. Well, like, you have to look for signs of the crash. Now, you can look at the health of the consumer. You can try to dive into the M2 money supply and become an economist. No problem there. You can do it. It's a good hobby to have. But like, I'm a real estate professional, so I look at the real estate data, and it tells me that we just don't have enough listings right now, to active listings, to trigger some type of catastrophic crash. There are pockets of the United States, maybe little zip codes here and there, that are crashing price-wise because they have a lot of supply. But nationally, that's just not the case. And in Ohio here, that's not the case either. So as long as active inventory remains suppressed, and even if new listings continue to increase, if the demand we have now gobbles them up, right? Think of it like Pac-Man, right? Pac-Man's going down and gobbling up the bits. If it can gobble them up quicker than they can be laid out and put on the screen, then you're still not going to have an inventory explosion and probably not going to have a housing crash. And that's like supply demand economics 101. That's how it is. But I have a question. So comment below. Are you in a house right now? Do you have a 3%, 4%, 5% mortgage? And you're like, no way I'm selling. It's not happening. I'm locked in. I'm one of those people. Or are you someone that does have a 3, 4, 5% mortgage and you're like, you know what? I think it's time to move. I'm moving. So love to know what market you're in and what you're experiencing right now. All right, now let's talk for a second about how you can find this type of data locally. You will hear people tell you that you can only access it on the MLS. Like, you have to have MLS access. Completely not true. If you are in a state that's a disclosure state, which most states are, then you can go to your county auditor many times and pull a list of all the properties that are currently for sale or have closed to get comparable sales. But on a website like Zillow, if you go to Zillow.com, you can do a radius search or a zip code search or a county search or a city search and narrow it down by price point and look at how many active listings you have. So look at the active listing count and watch it. Are you seeing houses in your price category? Not on all prices, but in your price category. So for instance, if you're looking at $400,000 to $500,000 houses, you put that filter into Zillow, or you can even probably put it in Redfin too, and then go, all right, I'm going to write the number down on Monday early in the month, and then look at it mid-month and write it down. Then look at it at the end of the month and write it down, and keep doing that. I mean, you could really just write it on a scratch pad if you wanted to track it and say, how many houses are active out there, and is it building? If it's building and they're sitting on the market longer and longer and longer, it could be a sign that prices could start to come down. However, if you don't see that in your price category, remember this, in your price category, then it's probably a good sign that prices will remain sticky. That's just kind of the way life is sometimes, right? You don't really get what you want. You want lower prices. I understand that. Everybody does. But if inventory isn't increasing, the chances of having a crash or lower prices are nil to none. So anyway, that's my video for today. I really appreciate you watching this. I appreciate your time, your attention. Hit the like button if you got any value, any value out of today. Please hit the like button and consider subscribing. I post regular updates about the national and Ohio real estate market, and we'll see you on the next video.